Hello and welcome to Storage Trader. Our online platform is the first one built exclusively for investment in self-storage facilities. This YouTube channel shares educational information about self-storage investing designed for both owners looking to raise capital and investors looking to place capital. Before we dive in, make sure to subscribe so you don't miss more videos like this. If you find this information helpful, don't forget to hit that thumbs up button. This segment is titled, In Real Estate, the term cap rate is thrown around a lot. But what exactly is a cap rate, and how does it apply to self-storage facilities? Self-storage facilities are becoming increasingly popular to invest in across the United States. This is due in part to the high cap rates that investors can earn on these properties. In this blog post, we'll discuss what cap rates are and how to calculate them. We'll also take a look at what cap rates are considered good for the self-storage industry. A cap rate, short for capitalization rate, is a measure of the expected return on investment for a real estate property. The higher the cap rate, the higher the return on investment. Cap rates are calculated by dividing the net operating income, NOI, by the current market value or sale price of the property. To calculate a property's cap rate, you'll need to know two things: the property's current market value, or sale price, and the property's NOI. The current market value, or sale price, is pretty self-explanatory. It's simply how much the property is worth on the open market. The NOI, on the other hand, is a little more complicated. The NOI is calculated by taking the property's gross income and subtracting all of the operating expenses associated with the property. These operating expenses can include things like insurance, taxes, utilities, repairs and maintenance, and payroll. Once you have both the current market value or sale price and the NOI, you can calculate the cap rate by dividing the NOI by the current market value or sale price. For example, let's say that a self-storage facility has a current market value of $1 million and an NOI of $100,000. To calculate the cap rate, we would divide $100,000 by $1 million to get 0.1 or 10%. Now that we know what cap rates are and how to calculate them, let's discuss what sort of cap rates are considered good for self-storage facilities. As a general rule of thumb, most investors look for properties with cap rates of 4%, 10% or higher. However, in recent years, cap rates have been declining as more and more people have been investing in self-storage facilities. As a result, it's not uncommon to see properties with cap rates below 10%. Cap rates are often used by investors as a quick way to compare properties. For example, let's say you're considering two self-storage properties, Property A and Property B. Both properties are priced at $1 million. Property A has an NOI of $100,000, while Property B has an NOI of $200,000. Which property would have the higher ROI? For Property A, divide the $100,000 NOI by its $1 million price tag to get a 10% ROI. For Property B, divide the $200,000 NOI by its $1 million price tag to get a 20% ROI. As you can see from those calculations, Property B would have the higher ROI, 20% compared to 10%. Therefore, if you're looking for a higher return on your investment, Property B would be the better choice. One potential drawback of using cap rates is that they only take into account one aspect of a property's performance, the NOI. While the NOI is certainly important when it comes to estimating ROI, it's not the only factor that should be considered. For example, a property with a lower NOI but stronger prospects for future growth could ultimately generate a higher ROI than a property with a higher NOI but weaker prospects for future growth. As such, it's important to use caution when relying solely on cap rates when making investment decisions. Wrapping up, the definition of a cap rate can be confusing to those who are new to real estate investing, but once you understand what they are and how to calculate them, Cap rates can be a valuable tool for assessing the potential profitability of a property. Be sure to listen to the following disclaimer. Storage Trader LLC is not a registered broker-dealer, investment advisor, or crowdfunding portal. None of the information contained in this recording is a recommendation to invest in any securities. Investing involves risk, and you should not enter into any transaction unless you have fully understood all risks and have independently determined that such transactions are appropriate for you. The information provided here is without regard to any particular user's investment objectives or financial situation. Please consult with your legal and financial advisors before investing, and do not invest unless you are able to sustain the risk of loss of your entire investment. Any financial projections provided in this recording, including without limitation expected IRR, are forward-looking statements and may not reflect actual future performance. Investment in any opportunities presented on this website are for accredited investors only as such term is defined by Rule 501 of Regulation D, promulgated under the Securities Act of 1933. The general information provided on this recording is not an offer to buy or sell, or the solicitation of an offer to buy or sell any security, and potential investors will be provided with a confidential offering memorandum prior to being offered a security. We hope you enjoyed this installment of Storage Trader's audio blog. Additional episodes may be found at storagetrader.com on our news page. Select Read More for the article you want to listen to, then click the Listen Now button. Or you can subscribe to our YouTube channel using @StorageTrader. The end.